For decades, he ran the most successful investment fund on Wall Street. It never had a losing year. Not when the dot-com bubble burst, not when the towers fell, not when markets around the world went into freefall. Year after year, his clients earned around 1% a month, calm and steady, like clockwork, while everyone else rode the chaos up and down. The smartest people in finance begged to give him their money. Charities, universities, banks in Geneva and Tokyo, Hollywood royalty, Nobel laureates. To be let into his fund was a status symbol most billionaires could never reach. There was just one problem. None of it was real.
There were no trades, no strategy, no secret edge. Behind the marble lobby and the private elevators, the returns were being typed into statements by hand, invented numbers on paper, backdated to look perfect. The man at the center had not made a single trade for his investment clients in years. Prosecutors would later say it had been going on for decades. By the time it collapsed, the fund claimed to hold roughly $65 billion. It was the largest financial fraud in history, and it was built by one of the most trusted men in the entire industry.
This was not some anonymous con artist working out of a basement. This was the former chairman of the NASDAQ stock market, a pioneer who helped build the modern electronic exchange, a man whose name opened every door in New York. His name was Bernard Madoff, and the question that has haunted Wall Street ever since is simple. If the fraud was this enormous, this obvious in hindsight, running for years in plain sight, then how did nobody stop it? Because someone did try. One analyst spent 9 years warning the government, handing over a detailed map of exactly how the scheme worked. And every single time, he was ignored.
This is the story of how a lifeguard from Queens became the most powerful man on Wall Street, and then the most hated. How he turned trust itself into a weapon. How he fooled regulators, auditors, and some of the richest people alive. And how, in the end, it was not the government that brought him down. It was a phone call from his own 2 sons. To understand how $65 billion could vanish, you have to go back to the beginning, long before the private jets. Back to a young man with a $5,000 stake, about to learn that on Wall Street, the most valuable thing you can sell is the feeling that you cannot lose.
Bernard Lawrence Madoff was born in Queens, New York in 1938 into a working-class family that knew what it meant to have money slip away. His father tried business after business, most of them failing. And from a young age, Bernie wanted something his family never had: respect. The kind that came from a name people trusted. He was not the smartest student. He was not born into Wall Street money. But he had 2 things in abundance: charm and an almost supernatural patience. He could wait years for a plan to pay off. To raise his first stake, he worked as a lifeguard on the beaches of Long Island and installed lawn sprinkler systems. Dollar by dollar, he saved about $5,000. In 1960, he used that money to found his own firm, Bernard L. Madoff Investment Securities. He was just 22 years old. By his side was his wife, Ruth, who had studied psychology at Queens College and would help run the books. It was, from the very start, a family operation, and family was the word that would sell it for the next 50 years. $5,000 was not enough to compete on Wall Street, so Bernie turned to his father-in-law, an accountant named Saul Alpern. Alpern lent him $50,000 and did something far more valuable. He began referring his own friends, clients, and their families to the young man who had married his daughter. These were the first outside investors. Doctors, dentists, small business owners, ordinary wealthy people who trusted their accountant. They had no idea they were the opening chapter of a story that would end in the largest fraud the world had ever seen. $5,000 was not enough to compete on Wall Street, so Bernie turned to his father-in-law, an accountant named Saul Alpern. Alpern lent him $50,000 and did something far more valuable. He began referring his own friends, clients, and their families to the young man who had married his daughter. These were the first outside investors. Doctors, dentists, small business owners, ordinary wealthy people who trusted their accountant. They had no idea they were the opening chapter of a story that would end in the largest fraud the world had ever seen.
His firm grew into one of the largest market makers on Wall Street, at times handling a huge share of the daily trades on the New York markets. This part of the business was completely real. It was legitimate, sophisticated, and enormously profitable. Madoff helped pioneer the technology that would become the NASDAQ, the electronic stock market, and in recognition, he was named its chairman. Think about that. The man who would run the biggest fraud in history was, for a time, the public face of an entire American stock exchange.
That title changed everything. Regulators did not just trust Bernard Madoff, they consulted him. He sat on committees. He advised the government on how markets should work. His name was a seal of approval. When you met him, you did not meet a con man. You met a soft-spoken elder statesman of finance, a man who seemed to have nothing left to prove. And that respectability was the perfect cover, because it made a single question feel almost rude to ask. How exactly was he making his clients so much money, so consistently, for so long?
For decades, no one pushed hard enough to find out. The legitimate trading business lived on one floor of his Manhattan headquarters, humming with screens and traders in plain sight. But there was another floor, a quieter one, the 17th. Few employees were allowed inside, and those who were rarely spoke of what they did there. On paper, it was where Madoff managed money for a select group of investors. In reality, prosecutors would later say, it was the engine room of the lie. And to understand how that lie actually worked, you have to step onto the 17th floor.
So how was it supposed to work? When investors asked, Madoff gave them a name that sounded impressive and just complicated enough to end the conversation: the split strike conversion. In theory, it was simple. He would buy a basket of America's biggest, safest blue-chip stocks. Then he would protect that basket with stock options, financial contracts that act like insurance, capping the losses if the market fell and trimming the gains if it soared. The result, he explained, was a smooth, steady climb with none of the terrifying drops. It was the kind of strategy that sounded boring, conservative, and above all, safe. And the beautiful thing for Madoff was that the math behind options is genuinely complex. Most investors did not understand it. So when the returns came in month after month, they did not question the engine. They simply trusted the mechanic. And the mechanic had once been chairman of the NASDAQ.
There was only one flaw. According to prosecutors, none of it ever happened. There were no blue-chip baskets, no options, no trades at all. On the 17th floor, a small team ran what was, in effect, a document factory. Using old computers and dot matrix printers, they produced millions of pages of trade confirmations and account statements for transactions that never took place. And here was the genius of it. The trades were invented by looking backward. Staff would take the real prices the market had already hit on a given day, then print statements showing Madoff had bought low and sold high on those exact dates. Perfect trades, chosen with the one advantage no real investor has: the benefit of hindsight. The man prosecutors said ran this operation day to day, Frank DePascali, later pleaded guilty and admitted the business had executed no genuine trades since the 1970s.
Now, you might expect a fraud this big to promise something outrageous: double your money in a year, guaranteed riches. Madoff did the opposite, and that was exactly why it worked. His fund returned only about 1% a month, roughly 10 to 15% a year. Impressive, but not insane. Not enough to scream scam. What made it impossible was not the size of the returns, it was their smoothness. Real markets lurch up and down, violently and unpredictably. Madoff's line went up and up and up, in almost every market, in almost every year, like a heartbeat that never skipped. To a careful eye, that impossible calm was the single biggest red flag of all. But most investors did not want to look carefully. They were making money. Their friends were making money. And the man behind it bore the reputation of a saint.
Underneath the paperwork, the machine was the oldest con in finance, a Ponzi scheme. There were no profits. When an investor asked to withdraw money, they were not paid from clever trading. They were paid with cash freshly deposited by newer investors who believed their own money was being invested too. As long as more money flowed in than flowed out, the illusion held, and the statements looked flawless. It could run for years. It could run for decades. But a machine like this has one fatal weakness. It can never stop feeding. The moment more people want their money out than are putting money in, the whole structure collapses in on itself. So Madoff needed something to keep the cash pouring in, year after year, in ever larger amounts. He needed a network, a set of channels that could reach around the world and funnel fortunes onto the 17th floor. That network had a name: the feeder funds.
Here is what most people get wrong about Madoff. He did not spend his days cold calling strangers, begging for money. He did the opposite. He built a network of middlemen, funds run by other people whose entire job was to gather billions of dollars from investors and quietly feed it to him. These were the feeder funds. And Madoff's masterstroke was how he treated them, as if he did not need their money at all. He was famously hard to reach. He turned people away. Getting into a Madoff fund was made to feel like being accepted into a secret society, an honor reserved for those who did not ask too many questions. In a world where salesmen chase you, the man who acts like he does not want your money becomes irresistible. Scarcity was the marketing, and the more he pretended to keep people out, the harder they pushed to get in.
The largest of these channels was Fairfield Greenwich Group, run by a smooth, well-connected financier named Walter Noel. Fairfield alone funneled more than $7 billion of clients' money to Madoff, and they were paid handsomely for it, earning roughly $400 million in fees in just 3 years, charging their clients far more than a typical fund would. Think about that arrangement for a moment. Fairfield collected enormous fees for one service: access to Bernard Madoff. The more they raised for him, the richer they became. It was a powerful reason to keep the money flowing and the questions quiet. Whether the returns were real or not, the incentive for everyone in the middle was the same. Do not look too closely at the golden goose. Just keep feeding it and keep collecting.
Fairfield was only the beginning. A money manager named Ezra Merkin steered more than $1 billion to Madoff through his own funds, sweeping in universities, charities, and Jewish nonprofits who trusted him completely. Many never told their money was going to Madoff at all. And the network reached far beyond New York. Money poured in from the wealthy of Europe, from private banks in Switzerland and Spain, from investors across Asia and the Middle East. Fortunes crossed oceans, passed through fund after fund, and landed invisibly on the 17th floor of an office building in Manhattan. Each layer of middlemen made the trail harder to follow and made the whole thing feel more legitimate. After all, if this many sophisticated banks and funds were involved, how could it possibly be a fraud? One of those channels was run by a French aristocrat named René Thierry Mégon de la Villehuche, whose firm opened Madoff's door to European nobility and old money families. He directed around $1.5 billion into the fund, much of it his own and his friends. He believed in Madoff completely. That belief would cost him everything, and in the days after the collapse,
he took his own life, the first unbearable glimpse of the human wreckage still to come. Together, these feeders turned a large fraud into a global one, unstoppable and self-reinforcing, growing bigger every single year. But that was also its danger. Something this enormous leaves a shadow. And far from the champagne and the private banks, one stubborn analyst had already looked at Madoff's impossible returns, run the numbers, and reached a single chilling conclusion. It was mathematically impossible.
In Boston, there was a financial analyst named Harry Markopolos. He was a numbers man, an expert in exactly the kind of options trading Madoff claimed to be doing. In the late 1990s, his own firm asked him a simple question. Madoff is posting these steady returns. Can you build a product that does the same? So Markopolos sat down to reverse engineer the strategy. And almost immediately, something was wrong. He later said it took him about 5 minutes to know the numbers could not be real, and another 4 hours to prove it mathematically. The returns were too smooth, too consistent, defying the basic behavior of markets. You cannot copy a strategy that does not exist. To Markopolos, this was not a hunch or a suspicion. It was arithmetic. Madoff's track record was, quite simply, impossible, and the math left no other explanation than fraud.
The deeper he dug, the worse it looked. Madoff claimed to be moving billions in and out of stock options, but Markopolos calculated that the number of options he'd need simply did not exist in the entire market. The trades Madoff described could not physically have happened at that scale. There were other red flags, too. A giant, world-spanning operation audited by a tiny, unknown accounting firm working out of a strip mall. A fund that reported almost no losing months across years of chaos. A man who kept the actual investing arm hidden and refused to let anyone truly examine it. Any one of these was troubling. Together, they were damning. Markopolos gathered it all into a detailed case and did what any responsible person would do. He handed it to the government regulators, whose entire job was to catch exactly this.
He went to the Securities and Exchange Commission, the SEC, not once, but again and again, in 2000, in 2001, and most forcefully in 2005. That final submission carried a title that could not have been blunter. The world's largest hedge fund is a fraud. Inside, he laid out around 29 separate red flags pointing to a Ponzi scheme. It was a roadmap, a gift, everything a regulator would need to bring the whole thing down. And the SEC did almost nothing. They treated the case as thin and circumstantial. They did not issue subpoenas. They made polite requests for documents, poked around the edges, and ultimately walked away. The most detailed fraud warning in Wall Street history landed on the right desk and was quietly filed away. Why would they ignore it? The answer is the same force that powered the entire scheme: reputation. To the SEC, Bernard Madoff was not a suspect. He was a legend, a former NASDAQ chairman, an advisor to regulators, a pillar of the industry. It felt almost absurd to imagine that this respected elder statesman was running a criminal enterprise from a hidden floor. His good name was bulletproof. Markopolos, meanwhile, grew genuinely afraid, convinced that exposing a fraud this large could put his own life in danger. For nearly 9 years, he was completely right and completely ignored. The one man who did the math could not break through the wall of Madoff's reputation. In the end, it would take no whistleblower and no regulator to stop the machine. It would take a catastrophe large enough to shake the entire financial world at once. The catastrophe came in 2008. As the global financial crisis tore through the markets, banks collapsed, stocks went into free fall, and investors everywhere desperately needed cash. So they did the one thing Madoff's machine could not survive. They asked for their money back, all at once. Between September and December of that year, panicked investors tried to pull around $7 billion out of the fund.
In the first week of December alone, redemption requests hit roughly $7 billion. And the money simply was not there. It had never been there. For decades, the river of new deposits had always been wide enough to cover anyone cashing out. Now, the river had run dry. Everyone wanted out at the same moment, and the oldest trick in finance was about to meet the one force it could never beat: a stampede for the exits.
Madoff knew it was over. In his final days of freedom, prosecutors said, he tried to do one last thing: quietly distribute the few $100 million still left in the accounts to a chosen circle of family, friends, and favored employees ahead of the collapse. But there was no stopping what was coming. On December 10, 2008, he asked his two sons, Mark and Andrew, to come to his Manhattan apartment. There, the most trusted man on Wall Street finally said the words out loud. It was all a lie. The investment business, he told them, was basically a giant Ponzi scheme. He was finished. He had absolutely nothing left. Decades of impossible returns, the private elevators, the 17th floor, all of it, one enormous fraud. And now, the man who had fooled the world was confessing to his own children.
His sons worked at the firm, but they later said they had no knowledge of the fraud until that moment, and they faced an impossible choice: protect their father or turn him in. They chose the law. That same night, they contacted an attorney who took the information straight to federal authorities. The next morning, December 11th, 2008, FBI agents arrived at Madoff's apartment. An agent reportedly asked him whether there was an innocent explanation. Madoff's answer was simple and final. There was no innocent explanation. He was placed under arrest, and the largest financial fraud in human history was at last out in the open. It had taken his own sons to do what regulators and warnings never could. Madoff was charged with 11 felony counts: securities fraud, wire fraud, money laundering, perjury, and more. The numbers were almost too large to hold in your head. The account statements had claimed around $65 billion. The original criminal complaint put investor losses near $50 billion. Thousands of victims woke up to discover that the fortunes on their statements, savings, pensions, entire family legacies had never existed at all. In a single day, the wealth of decades evaporated into paper and lies. But the arrest was not the end of the story. It was the beginning of a reckoning. Because now the world had to add up the true cost of what Bernard Madoff had done. And that cost would be measured not only in dollars, but in human lives.
When the fraud collapsed, the world saw who had really been standing behind those account statements. Not just billionaires and banks, but thousands of ordinary people, retired teachers, widows, small business owners who had handed over a lifetime of savings. Entire charities and foundations were wiped out overnight, their endowments gone in an instant. Among them was Elie Wiesel, the Holocaust survivor and Nobel Peace Prize laureate, whose foundation lost nearly all of its assets, around $15 million, with his family's personal losses reported to be even greater. When Wiesel was later asked if he could ever forgive Madoff, his answer was a single word: no. Because what Madoff had stolen was not only money, it was the trust of people who had believed in him for decades.
Justice came quickly. On March 12, 2009, Bernard Madoff pleaded guilty to all 11 counts against him. There was no deal, no bargain, and no real explanation for how a man could live inside a lie for so long. Then, on June 29, 2009, he stood before Judge Denny Chin to be sentenced. The judge called the crimes extraordinarily evil, unprecedented in their scale and their cruelty, and he handed down the maximum: 150 years in prison. For a 71-year-old man, it was far more than a life sentence. It was a symbol, a number meant to speak for every victim.
When the sentence was read, the courtroom reportedly broke into applause. Bernard Madoff would die behind bars. But the harshest punishment of all was not the one the court delivered. The deepest devastation fell on his own family. His sons, Mark and Andrew, were the ones who had turned him in. Yet they were pursued by lawsuits, hounded by the press, and forever tied to a name that had become a symbol of greed. The weight of it was crushing. On December 11th, 2010, exactly 2 years to the day after his father's arrest, Mark Madoff took his own life. His younger son, Andrew, who had long battled cancer, died in 2014 and spoke openly before his death of how the scandal had poisoned the family's final years. Their mother, Ruth, once a fixture of New York society, ended up largely alone, cut off from the world she had known. Whatever Madoff had built, it had consumed not just strangers, but the people closest to him. As for Bernard Madoff himself, he spent his final years in a federal prison medical center in North Carolina, an old and ailing man, reviled around the world. He died there on April 14th, 2021, at the age of 82, still without ever fully explaining how he had sustained the lie for so long. And that could have been the end, a story of pure loss, of money and lives swallowed by one man's deception. But it is not where the story ends. Because from the moment of the collapse, a quiet, painstaking effort had begun behind the scenes to chase down the stolen billions and return them to the victims. Almost no one believed much could be recovered. They were about to be proven spectacularly wrong. As for Bernard Madoff himself, he spent his final years in a federal prison medical center in North Carolina, an old and ailing man, reviled around the world. He died there on April 14th, 2021, at the age of 82, still without ever fully explaining how he had sustained the lie for so long. And that could have been the end, a story of pure loss, of money and lives swallowed by one man's deception. But it is not where the story ends. Because from the moment of the collapse, a quiet, painstaking effort had begun behind the scenes to chase down the stolen billions and return them to the victims. Almost no one believed much could be recovered. They were about to be proven spectacularly wrong.
The man given the task of cleaning up the wreckage was a lawyer named Irving Picard, appointed as trustee to recover whatever he could for the victims. And Picard's strategy was as clever as it was controversial. He understood a crucial truth about the numbers. That famous figure, around $65 billion, was mostly fiction, fake profits that had never existed on paper. The real money, the actual cash that victims had deposited over the years, was closer to $17.5 billion. So Picard went hunting for it. He sued the net winners, the investors and feeder funds who had pulled out far more than they ever put in, walking away with other victims' money. He pursued the banks that had fed the machine. Slowly, settlement by settlement, lawsuit by lawsuit, he began clawing the stolen fortune back. Almost no one expected much. In most Ponzi schemes, the money is long gone, spent or vanished, and victims are lucky to see pennies on the dollar. But the Madoff recovery became something entirely different. Over the years that followed, Picard recovered more than $14 billion, the vast majority of the real cash that had been lost. On top of that, a separate United States government fund distributed over $4 billion more to victims. Added together, these efforts returned roughly 94% of the money victims had actually lost. 94%. It stands today as the most successful recovery from a fraud of this size in history. A quiet, painstaking triumph that took more than 15 years and gave thousands of ruined people back something they thought was gone forever.
The scandal reshaped the financial world. The SEC, the regulator that had ignored Harry Markopolos for nearly a decade, was publicly humiliated, forced to overhaul how it investigates tips and hunts for fraud. Markopolos,
once dismissed as a paranoid outsider, was recognized as the man who had been right all along. And the case left behind a lesson that outlived Madoff himself. It was never really about complicated options or secret strategies. It was about trust. How the most powerful force in finance is not intelligence or math, but reputation. Madoff's greatest asset was never a trading system. It was his good name. The decades of respect that made people believe questioning him was almost rude. That is what let the lie survive in plain sight for so long.
So think back to where we began. A fund that never had a losing year. Returns that climbed like clockwork, calm and certain through every storm. That intoxicating feeling that you simply could not lose. That was the whole trick. Real investing is never smooth, never certain, never safe. The moment someone promises you a straight line up with no risk and no bad days, you are not looking at genius. You are looking at a warning. Bernard Madoff proved that the most dangerous words on Wall Street are not "get rich quick." They are two simpler ones. Trust me. He built the largest fraud in history, not on brilliance, but on belief, and the willingness of thousands of people to stop asking one basic question: where exactly is the money? In the end, it was never there at all.